What a week, because you had the president traveling overseas. He did NATO, then, of course, went to the UK to meet with Theresa May, and he's on his way to be meeting Vladimir Putin in Helsinki. Let's talk about all of this and the trade issues that certainly came up in the NATO meeting. You feel that this has been a misunderstood issue?
Well, to some degree, I think people don't understand, what is going on, and for investors, it's extremely confusing. So let's divide it up. What is the purpose of having a trade war? It's obviously to change the way trade is actually done in a way that favors the U.S. And what are we concerned about? Intellectual property rights, software rights, and things like that. But what happens in terms of its economic impact is far different. And what people underestimate is the degree to which this trade war could affect U.S. companies' earnings. Economists always talk about the impact on GDP, and you can imagine a full-blown trade war reducing GDP by 0.5% or 0.6%. But the real story is that you could ultimately have $100 billion in reduction in earnings in the U.S. if you had a full-blown trade war for a year, let's say, and that would be 10% of sort of large-cap earnings in the United States. So we're talking about a very significant issue for investors.
But I feel like this market has been giving this president and this administration some leeway. They believe he's negotiating. Because if not, I feel like this market would be way down if they didn't actually trust that at the end of the day, we will probably get a better outcome.
I think that is somewhat true. That's certainly not true in China. It's not true in the emerging markets. It's not true in the automobile industry. But if you look at the U.S. aggregate indices, I think that is true. And so therefore, what do you make of that? Well, the question is, are we actively negotiating? And there's mixed evidence to that impact right now. You've seen articles come out this week about the fact that there aren't active negotiations that are going on right now.
The president told me 2 weeks ago when I sat down with him in my exclusive interview that lots of countries are calling. He said, you don't know this, but lots of countries are calling and they want to do a trade deal. But I agree with you. At some point, we've got to see those trade deals on the books. He's got to get a deal done in order for the uncertainty to go away. Is that one of the big issues that you focused on in terms of how to invest right now?
Right. I mean, at Citi Private Bank, when we put out our mid-year outlook, we really looked at two, contradictory trends. One is incredibly strong U.S. earnings and good earnings in Europe and in Asia as well. That's the positive. The negative is the impact that a trade war could have on portfolios and investor confidence, and then over the longer term on actual investment by corporations. And we see that as potentially significant, and we're beginning to see signs of weakening already, in terms of commitments that CEOs are willing to make on investing.
Let's talk about earnings. The earnings season for the second quarter kicked off this past week. On Friday, we got JP Morgan, which was above expectations. Wells Fargo missed. PNC was better than expected, but I believe Citi, obviously you're from Citi, so we won't go there. But in terms of the overall earnings period, how would you characterize it?
I think it's going to surprise people a little bit to the upside. Our expectation is that in the aggregate, earnings could be up 20 to 22%. Which is a lot, and it's not just driven by the tax cuts. So it's a very strong period of time for U.S. corporations. And yet, U.S. stocks are not moving. To your point earlier, when we said there hasn't been a lot of impact in the U.S., what would U.S. stocks be, if the trade situation, was not as significant as it is? And they may be, 10% higher than they are now. So I would argue that the impact is pretty significant.
So you think that we could see a real reaction once we get some deals done, and if we don't get a deal done, same thing on the other side.
Right, we're seeing exactly correct. In the U.S., if a series of transactions get done, but especially with China and with NAFTA, then you would see the markets, I think, pop to the upside. Similarly, if we go to a full-blown trade war with China, and we're talking $500 billion in tariffs now, that would have a very deleterious effect here, potentially, and further bad effects elsewhere.
Where do you see the opportunity around the world right now?
Right. So if you look at, let's just say, Europe, and the discount Europe is trading to the United States, we're probably at 17 times forward earnings. Europe is at 13.5 times. European stocks have an average dividend of almost 4%, and European companies are going to do better than people expect. So we like that. Same is true with China. Right now, China is extremely cheap. It's a market that's trading itself under book value. It's trading at under 11 times forward earnings. It's an attractive market. It's an area actually where we want our clients to go overweight. And then emerging markets, which were cheap before, are actually a little bit cheaper now, given what's gone on in the world. Clients should be exposed there. And the reason is because economic cycles obviously are taking place at different times. The U.S. is late in its cycle. whereas, of course, the emerging markets and Europe are actually less well advanced in their economic cycles.
So it doesn't bother you in terms of China that they are stealing our intellectual property, that we are on the doorstep of this fight that the two countries are having over trade? You want more exposure to China.
Right. As an investor, you do. And that's the weird thing. Of course, I'm not in favor, and we're not in favor of intellectual property theft.
Right.
And we think that that's the area that trade should be renegotiation should be focused on. But when you look at it as an investor and you're thinking out 5 or 10 years, wealthy clients around the world want to basically build a portfolio. China today represents 20% of the economy and 0.3% of the world equity indices that MSCI just changed. So we know if you look out over 5 or 10 years, you're going to want to have 10%, 15% of your equity portfolio in China, and the average client today has very little.
David, it's great to have you on the program. Thanks so much.
Thanks you very much, Maria. Pleasure to be here.
We appreciate you joining us. David Bailin from Citi Private Bank.